Accounts receivable often makes up a good proportion of a business's current assets. Accounts receivable is money earned but not yet received, and it is therefore important that businesses have as much control and understanding of the nature of accounts receivable as possible to be able to make wise decisions regarding cash flow. When a customer pays on credit for a company's good or service, it is recorded as credit sales. Credit sales are added to the accounts receivable account on the balance sheet. Once the money is paid, it becomes revenue, and like any other sale from there on, the business can decide what to do with the money. So the problem is really in the first few steps. The time between a credit sale being made, i.e. a customer purchasing a product or service, and a revenue being recorded, i.e. a customer actually paying you, is variable. Sometimes debtors sit in the accounts receivable for a very short time. Other times it can be a while before debtors get their act together and pay up. Now, it's actually useful for companies to be able to predict how long the money will sit in accounts receivable before debtors pay what they owe. But it's not as simple as saying, "Hey mate, how long will it take you to pay me?" This is why analysis is needed. If companies can predict the amount of time that elapses between a credit sale and a revenue received, then companies are able to make financial decisions with understanding of future cash flow. Congratulations! This nice-looking man has just hired you as his primary accountant in his very large yet slightly ambiguous firm. Your new boss said he's owed money all over town, and he wants to know when he's going to get paid. He gives you all the financial records of the company and asks if you could give him the accounts receivable turnover ratio for 2016. The accounts receivable turnover ratio tells you how many times debtors pay what they owe over a period of time. We arrange credit sales at the top of our equation, and then beginning receivables and end receivables at the bottom. Slap in a plus sign and divide the bottom two by 2, and there's your ratio. After much rummaging through the financial records of your new company, you find the right numbers. $60,773 in credit sales with a beginning inventory of $926 and a closing inventory of $969. Divide that by 2, and voila! Your accounts receivable turnover ratio is 64.17. That means that in 2016, the people who owed you money paid approximately 64 times. Happy, boss? Ooh, clearly not. It seems like your boss wants to know how often he gets paid, i.e. how many days elapse until accounts receivable is in fact turned over. Lucky for you, that's the easy bit. Just divide 365 by your accounts receivable turnover ratio, equals 5.6 or 6 rounded up. So, on average, every 6 days you get paid by your debtors. With this information, your new boss can predict the future cash flow and therefore make more informed decisions regarding business finances. And isn't he happy about it?